Hello everyone, this is Kevin Zhao, your finance professor at MTSU. In this video, I was going to show the basics of investments. As I said, Investments Finance 6460 is an advanced course with a focus of equity evaluation. Before we go through those advanced topics, I would like the class to review the basics of investments. For most people in this program, I would say 2/3 of students typically were majored in business for their undergraduate studies. Typically, they took the class of investments at MTSU, that is 3810. If you already took investment class, I think this class would be pretty easy for most of you, but we do have some students came from different areas such as engineering, liberal arts, or other majors, and even computer science, or chemistry, physics, and so forth. So if you haven't had a chance to take a typical business course, a business required course such as investment for the 10, then I think during the first couple of weeks in this class, you should spend some time to learn some investment basics. So here are the textbooks that I highly recommend for those who really wanted to start looking at the 101 of investments, or basics of investments. That's Fundamentals in Investment Management by Hurt and Block. 10th edition will be fine. If you look at older edition, that will be okay as well. Other investment textbooks are equally good, just that some of them are more for graduate students, others are for undergraduate students. So just to pick a investment books, typically for undergraduate students, then read through those chapters. Those are easy chapters, however, it takes some time for you to understand basic terminologies, concepts, investments. And the second book that I highly recommend is Essays of Warren Buffett, Lessons for Corporate America. I use this in my investment class for undergraduate students, and this book is even a better book for you to read because it doesn't even have any formulas of mathematics or financial ratio analysis. It's all easy English that everybody can understand. However, this book can lift you up to another level in terms of understanding of investment, very basic principles of investments. So two books that I highly recommend to you. One is Fundamentals of Investment Management by Hurt and Block, 10th edition, or older one. And the second one is The Essays of Warren Buffett. This is the only book that is written by Warren Buffett himself. In the market, you can find books talk about Warren Buffett, but this is one that is written by Warren Buffett himself. Okay, so what do you need to know for basics of investments? And here you see six very important topics that you typically needed to know before you're ready to go advanced level in investments. First one is security markets and market regulation. Second one is security trading mechanism. It's how you trade different types of securities. The third one is stock valuation and the top-down analysis framework for security analysis. The fourth one is bond pricing and analyzing the risk of bond investment. And the fifth one is financial derivatives such as futures and options. The last one is market analysis. For the first one, security markets. Here you are supposed to understand the basic difference between primary markets and secondary markets. And primary markets is a market where new securities were born, and the secondary markets are markets for existing securities to be traded among investors. And let's say if you wanted to buy Facebook stock on the stock market, typically it's a transaction for the secondary market. And if it's an IPO made by Facebook to issue new stocks, then it's a primary market transaction. So So IPO, what is IPO? IPO is initial public offering, which is the process where a company offers stocks to public to purchase. And during this process, we have a lot of third parties such as investment banks, accounting firms, law firms to help corporations to sell their stocks to investors. I think on one hand that is a corporation, on the other hand that is public investors. And the most important issue that needs to be resolved before stock can be sold to investor is to mitigate information asymmetry. So IPO process is a very important process where a lot of third parties helping corporations and investors to make a full information disclosure so that investor can know more about the current condition of the company, and also that information disclosure requirement is required by the law and overseen by regulator of SEC, Security and Exchange Commission. SEO, what is SEO? SEO is seasoned equity offering. That's the second time, third time, or fourth time that company issue their new stocks to public. NYSE, New York Stock Exchange, NASDAQ, those are two major secondary stock markets where existing shares of stocks are exchanged among investors. That's typical secondary markets. Other than New York Stock Exchange and NASDAQ, we have alternative markets such as ECN, BATS, and OTC. ECN, Electronic Communication Networks. It's like internet trading. And previously, we had several successful ECNs, those in year 2000 2001, but most of those successful ECNs right now are part of either New York Stock Exchange or NASDAQ. And so on the market, we have two major secondary stock markets, New York Stock Exchange, NASDAQ, and those two stock exchanges are very different because New York Stock Exchange has a physical trading location, which is located on Wall Street of New York City. Their centralized trading floor and the trading mechanism follows auction procedure. But for NASDAQ, it's different. NASDAQ is a dealer's market. It doesn't have a physical trading place. It's all electronic. It's more like internet. And on the internet, you will see a lot of brokers and dealers help investors to trade their securities, including stocks and bonds. So NASDAQ is not an auction market, but a dealer's market. So all the transactions have to be handled by either brokers or dealers on that network. By the way, what does NYSE mean? NYSE means New York Stock Exchange. And what does NASDAQ mean? NASDAQ means National Association of Securities Dealers Automated Quotation System. It was a internet-like system built by NSD, which is a regulator for security brokers dealers, back to 1970s. It's the first massive application of internet technology back to 1970s. Pretty advanced at that time because people began to use internet intensively in 1980s, but 20 years before that, the technology has been applied into stock trading on this NASDAQ. It's an automated quotation system built by NSD, National Association of Security Dealers. Okay, now let's take a look at three different types of people working in a trading floor. That is for brokers, stock dealers, and specialists. And if you have a chance to visit the trading floor of your stock exchange, you will see many different type of professionals. Some of those are floor brokers. They help their clients to submit their orders to the centralized trading platform to help them to execute their trading orders. And the stock dealers actually have dealers posts in the centralized trading floor, and they actually help brokers to execute those trades. And the stock dealers constantly post buy and sell orders, and they buy low, sell high, and make the difference as bid-ask spread, which is the revenue for stock dealers. And the reason why we need stock dealers because without stock dealers, it's very hard to make transaction happen as quickly as possible. And right now, for most liquid stocks, with the help of stock dealers, investors can make transaction happen within second. Right? Once you submit the order on your computer, okay, the next second your trade is executed. Thanks to stock dealers who provides liquidity to the market. The specialists are stock dealers who also trade stocks for themselves. So there are three different types of people on the central trading floor of New York Stock Exchange. Other than stock markets, we have bond markets, futures markets, option markets. And in New York City, we have New York Stock Exchange. Although you see Nasdaq in Times Square, but actually, as I said, Nasdaq is not a physical stock exchange. The Nasdaq office that you see in Times Square, New York City, is only for demonstration purposes. It doesn't have trading function in that place. The New York Stock Exchange does. They have centralized trading floor in that physical location. Nasdaq is an electronic trading system. It doesn't need a physical location. Okay, so New York City has stock market, largest stock exchange, New York Stock Exchange. But what about Chicago? Chicago is another financial center, and Chicago doesn't have any stock exchange, but it has three very important financial derivative markets: CBOE, CBOT, and CME. Both CME and CBOT are futures exchanges, and the CBOE is the option market, the largest option market in the United States and the globe. On the security markets, all the investors, participants need to follow a fair rule. In the market, we have a regulation, and here we need to who regulates what. In the stock market, we have regulator of SEC, US SEC. It's not for college football. It's a Securities and Exchange Commission. And SEC oversees the entire stock market. It regulates the behavior of those publicly traded companies and institutional investors as well. And the goal of SEC is to promote the integrity of the market and to make this market a fair place for all investors to participate. And the central mission is to strengthen the principle of information disclosure because between investors and a corporation, the most important issue to resolve is information disclosure or information asymmetry. Corporations know more than investors, and large financial institutions may know more than minority investors. So a long-term healthy security markets should promote a fair environment where all investors have the same access to financial information. And the most important role of the SEC is to promote fair disclose of information by corporations to all investors or to public. So that's SEC. And another job for SEC is to protect investor, and especially to protect the interest of minority investors, those are small investors like you and me, and make sure that the minority investors are not taken advantage by those powerful large institutions and corporations. Other than SEC, we have other regulators, and typical examples are U.S. Federal Reserve. U.S. Federal Reserve is central bank of the U.S. It regulates the banking system. It also regulates something on the stock market, such as the margin requirement. Margin requirement, if an investor wanted to do margin trade, there's certain limitation on how much money investor can borrow from a broker, and it is the Federal Reserve that actually set the limitation, which is the 1-to-1 ratio right now. So if you have $1 in your brokerage account, then if you have a margin income, then you can borrow up to another $1 from your broker. And you cannot borrow more than that. That's regulated by the Federal Reserve of the US. CFTC regulates the future markets. NSD regulates the behavior of security dealers and brokers. It's called National Association of Security Dealers, and it is the organization that invented and developed NASDAQ back in the 1970s. And right now, this organization has been involved into a new regulator called FINRA, Financial Industry Regulatory Authority. And this FINRA actually combines NSD and the regulatory arm in New York Stock Exchange to form a new organization. And this organization regulates security dealers and brokers. And if you want to be a broker or financial professionals, then you need to take tests and to get the license from FINRA. What is CFA? CFA stands for Chartered Financial Analyst, and the name of the organization is called CFA Institute. And CFA Institute is not a government body. Instead, is a self-regulation body organized by investment professionals. And the goal of CFA Institute is to enhance the integrity level among those investor professionals. One is the integrity, the other one is the competence. We will talk about the CFA later. And I'm a CFA charter holder. I help students at MTSU to involve in the CFA programs to get their CFA certification in the future. Now let's take a look at some important security market regulation laws. Security Act 1933 and the Security Exchange Act of 1934 are two most important regulation laws that regulate stock market. And the Security Act 1933 was passed in Congress right after the Great Depression. And the goal of this act is to enforce the information disclosure liabilities of corporations. So all the corporations, before they can sell stocks to the public, they have to make full and fair and on-time information disclosure to the public through certain filing requirements, such as prospectus for IPO, 10K report, which is an annual report each every year, and a quarterly report, 10Q report, and 10K report, which is a periodic report that a company can just submit to the SEC to review those important issues in corporations. And all those documents that need to be submitted to the SEC first, the SEC will make it publicly available right away. So make sure that all investors or potential investors will have the same access to the information that is disclosed by corporation. That's the main goal of Security Act of 1933. And the Security Exchange of 1934 established the regulator of the SEC, and it says, okay, right now we have law, then who's going to enforce this law, and how do we make this information disclosure requirement happen? So it talked about the details about how to implement Security Act 1933. It also established two illegal trading behavior. One is insider trading, and the other one is price manipulation. It defines those two different types of trading behaviors are illegal. Security Act Amendments of 1975 actually liberates the brokerage business. Previously, it's illegal to lower the price, lower the commission to compete for clients among those brokerage companies. But the Security Act Amendment 1975 said, okay, right now, brokers are free to lower their commission rates to compete for their clients. So this Security Act Amendment 1975 is very important. After that, we see the establishment of many discounted brokers, such as Charlie Schwab, E-Trade, air trade, so on and so forth, and those companies offer discounted price for retail customers who want to trade stocks. So that's the Security Act and Amendments of 1975, which liberates competition among stockbrokers. SIPC and the Security Investor Protection Act of 1970 provides federal insurance to brokerage customers like banking customers. If you have a bank account with a bank, then the bank will typically tell you, okay, the bank is issued by FIDC, your deposit is safe, right? In case the bankruptcy of the bank, your money will be issued by the federal government through the institution called FIDC. And on the security market, if you have brokerage account, if you have money in your brokerage account, and let's say broker actually goes bankrupt, then what will happen to your money? And due to this act, you don't need to worry because your money will be issued by the federal government agency called SIPC, Securities Investor Protection Corporation, and it serves the same role as FIDC, which provides federal insurance to brokerage customers. So in case a broker goes bankrupt, your money in your account will be safe and issue up to half of stocks. Sarbanes-Oxley Act in the year 2002 highlights the importance of internal control of corporations and require all publicly traded corporations to establish or strengthen their internal control regarding account information. And the most recent regulation is Frank-Dodd Act in the year 2010. It involves many aspects of financial services industries, and the goal is to protect the interest of investors and the clients of financial institutions. So those are important security market regulation, and the security markets are a big place for many participants to participate in specialized investments. Here we wanted to make sure the market is a fair place for all investors to participate, and here you see we have a lot of regulators overseeing the market, and as investors we need to understand what the regulations are so we can comply with regulation and laws to make sure we will not get into trouble in your future financial practices. Okay, the third topic is security trading mechanism, and here you need to understand the difference between retirement account and brokerage account, cash account versus margin account. And to define stock, we use symbol or tickers such as FB. FB is the symbol for Facebook. If you want to trade the stock Facebook, you need to tell the system what stock that you wanted to buy, right? And the system doesn't know Facebook, it doesn't know FB. FB is the ticker of Facebook. Investor can buy or sell stocks, and here the concept of long and short position. Long position means investor buys securities, buys stocks, and when you buy stock, you expect that stock price will increase, and you buy low, sell high, right? And your position is to expect that stock price will increase. In this case, we can say investors are bullish. That's why they build a long position for the stock or other securities. That's a long position when you buy securities. So the position in your account getting longer and longer. 100 shares, 200 shares, 300 shares. That's a long position. What's short position? Short position means you sell securities. You sell existing securities or even sell the securities you don't have based on the expectation that stock price will fall. So if stock price decline, what can you do? People say, hey, don't buy, right? And if you have the security, then you should sell. But what if you don't have that security? Well, people can still make money by doing short sell. They borrow shares from broker and short sell it. When they short sell it, they sell at a higher price. And in the future, when price goes down, they buy it back at a lower price. and then return the share back to their brokers to close the deal. It's called short selling. The difference in prices and profit for short selling. So short position is based on expectation that security price will decline. People can do both short selling and margin trade. Margin trade means you can borrow money to amplify your position in your stock investment. So you have $1. Okay. If you have margin account, you can borrow another dollar to double your position. Margin trade is risky because when you double your position, you double the risk of your investments. In case the price increase, you can double your gains. But what if stock price declines? Your losses will be double. Plus the interest that you needed to pay on the money that you borrow, you can lose more than 200% of losses that you're supposed to bear if you don't do market trade. When you submit an order, there are three types of orders that you can utilize: market order, limit order, or stop order. And market order simply says you accept any market price available at that time. And the advantage is that if you submit market order, you can make it happen as quick as possible. You will be the first person to get the next order executed. The downside of market order is you may lose control on the price. You may overpay the price for the security that you want to trade. The limit order actually give you the control on how much you want to pay, how much you want to get if you sell the security. So you define the price. Once you define price and enter your order into the system, then you have to wait. So the disadvantage of limit order is that you have to wait, but you don't know how long you should wait. Maybe a couple minutes, it could be a couple hours, couple days, or forever, depending on what price that you enter into the system. So that's limit order. And sometimes people use stop order. Stop order is something between market order and limit order. It becomes a market order if price hits certain threshold level defined by investor. What is bid-ask spread, and what does market dealer do? And stock change and the Nasdaq, there are lots of market dealers, and those dealers buy and sell securities constantly. The reason why they trade security is to get bid-ask spread. That's the difference between the bid and ask price. So what is bid? Bid is the price that investor can get if they wanted to buy a security, if they want to sell their security to a dealer, typically a little lower. And if they want to buy stock from the dealer, they need to take the ask price, which is a little higher. And the difference between bid and ask is the revenue for market dealer. Right? The reason why they are getting bid-ask spread as a revenue because market dealer trade securities constantly, providing the liquidity to the market, so that stock trade can be executed in a very efficient manner. Typically for those liquid stocks, the minute that you submit an order, next second your order has been executed. It's just that fast. Okay, other than market dealer, you see, okay, stockbrokers working for investors, help them to execute their security transactions, and they charge commission. They charge a commission. Broker charge a commission. Market dealer takes bid-ask spread. And for trade settlement, right now, US follows T+3 convention. T+3 means today you buy security, but it takes 3 days for that security to arrive. 3 working days, not including weekend and holidays, to arrive your account officially. So it's so-called T+3 settlement rule. So your question would be, hey, if I buy stock today, can I sell it today? Based on this trade settlement rule, you cannot, because on your book you don't. By the time that you purchase the stock is not in your account yet. It takes 3 days to arrive. Right? So in theory you cannot. However, in practice you could sell security right away, because you can essentially borrow the same share from the broker, and the broker will help investors to make that kind of trade happen. And more trade means more commission, and brokers love to help investors to trade securities very frequently. And investors make money in their brokerage account. What will happen to the tax? Well, there will be capital gain taxes. Typically, it's 20% for long-term capital gain. But for short-term capital gain, it varies depending on investors' personal income. If investor has higher income, then short-term capital gain can be as high as 45%. And the long-term capital gain tax is 20%. So that's a security trading mechanism. Now let's take a look at the stock valuation. And here you needed to know that the stock price equals present values of all future dividends. So this is a theoretical equation to get intrinsic value of the stock price. The reason why stock has price is because it pays dividends in the future. So when we take the present value of all future dividends, we get the intrinsic value of the stock price. However, this equation is very hard to implement because in reality, nobody can estimate with a great precision regarding how future dividends will be. You may be able to forecast next year's dividend, but the question is how can you forecast the dividend the company is going to pay in 10 years, in 100 years? And here we have ongoing assumption for any stocks. And when you talk about future, how long is that future? 10 years? Yeah, 20 years. Longer than 20 years. Maybe more than 100 years, more than 1 million years, or more than 1 zillion years. So when you talk about all future dividends, I mean, how many items are in your equation? I would say infinite number of items. So in practice, this equation is really hard to implement. So to simplify the problem, we have to impose certain assumptions, such as the assumption that we impose the constant growth model, where we assume, first of all, company pays dividend, and the second, the dividend grows at a constant rate of G. It's not that in reality a company has to do that, but it gives us a beginning point to get a simplified formula to estimate the stock price. So that's a constant growth model where stock price equals D1 divided by R minus G. Right? And most of the stocks do not fall in this model because first of all they may pay dividend, but the growth rates can be different in the future. And typically we use two-stage model to fix the scenario where a company has high growth in the next several years, and then high growth rate will decline to a constant number, which is the lower one, and then it will last into the future. And if that is the case, we use two-stage model, and you can impose different assumptions regarding the future growth of the company, and you can do 3-stage, 4-stage, and stage models. So that's stage models based on different assumptions of the growth rates. Other than constant growth model, two-stage model, which is based on dividends, we can also estimate stock value based on another type of cash flow, such as free cash flow to the firm, free cash flow to the equity. But in the very fundamental investment class, you're only required to understand the very basic constant growth model. And this model, actually reveals fundamental drivers of stock price. Dividend, the discount rate R, which is the cost of equity, and the growth rate. Those are 3 critical factors that shapes stock price. Other than absolute valuation system that we see here, constant growth model, two-stage model, dividend discounting model, free cash flow discounting model, we have valuation multiple approach, which is based on ratios such as P ratio, and those ratios reveals relative valuation of a security. And P here is stock price, and E years earnings. Let's say P ratio equals 10, that means, okay, it takes 10 years for the investor to recoup its investment. And high P ratio definitely means stock price is more expensive. Low P ratio means stock price is relatively low, but the P ratio is very sensitive to the growth. And some stocks have high P ratio because they have high growth. So if you want to compare different stocks regarding this P ratio, it's better to utilize PEG ratio. P ratio divided by G. So here, P ratio is controlled by the most sensitive factor of G. So you can see if the stock is truly undervalued or overvalued. Basics for stock valuation. Top-down analysis. Top-down analysis reveals the fundamental analysis approach of a conventional investment professional. And when you say conventional, you say, hey, I want to be a modern investor. Right? Conventional feels a little boring. However, let me tell you something. Warren Buffett is a conventional investor, right? And he is the most successful investor in history. And his success lasted for more than 50 years. This conventional wisdom or conventional approach of investments actually can deliver great performance. And today on Wall Street, most people, I would say majority of security analysts are following this fundamental analysis approach. And this fundamental analysis approach look at the fundamentals of the business. And what are fundamentals? Fundamentals can be analyzed through three levels. On the top, that's economic analysis. You look at the economic environment by analyzing the impact of fiscal policy, monetary policy, and social on the current economic situation, which will affect the value of the stock eventually. And sometimes people also look at the economic indicator to see what would happen in the future if certain number changes, such as interest rates, unemployment rate, inflation rate, so on and so forth. So that's economic analysis. That's on the top level. And on the bottom, we analyze individual stock. And our goal is to thoroughly understand its risk-return trade-off of individual stock by doing financial analysis. When we say financial analysis, we do ratio analysis typically, analyzing financial statements of the company, balance sheet, income statement, the statement of cash flow, and our goal is to get intrinsic value estimation. And in this class, we will focus on equity valuation, right? And we will learn a lot of detailed techniques to do so-called intrinsic valuation of a stock. That's a stock analysis. And between the top and down, we have middle level analysis, that is industry analysis. And for most professionals, that is the starting point or most important part of their analysis, just as Warren Buffett says. Stock analysis, stock investments is not about financial analysis at all to him. To him, the essence of stock analysis is business analysis, which is something that investors cover in their industry analysis. So if you work for an investment bank and do security analysis, and typically they have many teams, and each team actually focused on one or two closely related industry. And for years, the team actually developed their professional expertise in just one or two industry. So on the stock market, you just cannot be someone who can know everything, but the way that you survive or thrive in this industry is to build up your expertise, right? To build up your advantage for your security analysis by focusing on just one or two industry. And here, of course, you do financial analysis, but behind financial analysis, you wanted to have a very comprehensive knowledge about how company or a specific company operate and compete in a specific industry. So it takes a year for a typical financial analyst to establish his or her expertise in certain industry. Efficient market hypothesis. This is about the investment wisdom, and we have three level of efficient market hypothesis. Efficient market means market is smart. Market is smart. It's not about operational efficiency, but informational efficiency. And market efficiency hypothesis simply said market is smarter than any individual investors. Why is that? Because this market acts like a learning machine. Because each every time when investors are trading a security, they are bringing their opinions into the market. How do they form their opinion? Of course, they do their analysis, right? And they use money to trade. Therefore, stock price reflect all informations that investor know. Since on the market we have hundreds, thousands, or 10,000, or even million investors are trading same securities, and those people actually do like million times of analysis, and the stock price reflect equilibrium level of the stock price, which reflects all available public information. So in that sense, the stock market acts like a learning machine. It learns from all investors who participate in trading. So therefore, the stock price becomes very smart, very smart. It knows everything that investors know. So that's the essence of efficient market hypothesis. So if stock price is smart and this market knows everything, then what can individual investor do? Well, investor, you just cannot be the market. Right? And the market is like in artificial intelligence, and it can be any human beings, and you'd better to follow it. Right? You'd better to follow the market. So yeah, right now we have a lot of passive investment vehicles and passive investors who actually simply follow the market by investing index funds, and actually index funds beats more than 90% of active investors. So that's efficient market hypothesis. There are three levels of efficient market hypothesis: weak form, semi-strong form, and strong form. Weak form means all the historical records of stock trading, such as stock price, past stock price, and past stock trading volume has been reflected in the current stock price. Therefore, technical analysis will be useless if the market is weakly efficient. And the semi-strongly efficient hypothesis simply says, okay, the market knows not only past the price and volume, it also knows all publicly available information. So no matter how hard you do your security analysis, stock price no more than you do. You just cannot beat the stock price. It's a pretty sad statement, because it says, okay, we should all do passive investment, because there's no way that you can beat the market. So that's what strong for efficient market hypothesis said. But don't worry, it's hypothesis. In the market we have evidence showing that okay, markets may be efficient in certain place during certain time, but in certain time in certain places not that efficient at all. And the strong for efficient market hypothesis simply says even inside information is already embedded in the stock price. That's not common in the US, because insider trading is legally prohibited. For most stock, I can say for most stock, more than 99% of securities, you won't see strong for efficient market hypothesis, because insider are not trading. If they are not trading, then insider information is not in the stock price. But in some developing countries markets, you will see a strong for efficient market, because insider trading may be very popular in a developing country. And realistically speaking, I would say in the US, US market is efficient, but not as efficient as strong form, not as efficient as semi-strong. I would say it's something between weakly efficient and semi-strong efficient. So if you do active investment, you have a chance to beat the market. Right? But for most technical analysts, since this market is at least weakly efficient, therefore technical analysis can be useless. That's efficient market hypothesis. Bounded pricing. Okay, bounded pricing. Bounded pricing simply equals present value of all cash flows in bond, which includes coupons and principals. And for bond analysis, be careful about the percentages, coupon rate, interest rate, current yield, yield to maturity. They all in percentages. They look very similar to each other, but yield to maturity is the best number that we can use to measure the return on the bond investment. And the coupon rate. Often investors think a coupon rate tells investor the future investment return on the bond, but that is totally wrong. Coupon rate says nothing about bond investment return. It only shows the coupon payment. That's all. It is a year to maturity which shows the bond investment return. And the year to maturity can be calculated. It can be calculated by using your calculator. If you know coupons, principals, number of years, number of years in a bond. That's year to maturity. And if you know year to maturity, you can estimate the bond price. If you observe bond price, you can estimate year to maturity. But if you have estimate year to maturity, then you can estimate bond prices. And the yield curve is very important. It's also called term structure of the interest rates. It's a two-dimensional picture showing the relationship between time to maturity and the interest rate. So sometimes year to maturity, this yield curve can be upward sloping or downward sloping, but the direction of the yield curve actually carries the information of what will happen on the bond market, especially associated with short-term interest rates. So typically, if it's a upward rising yield curve, it indicates that interest rate is going to go up and the market, the economy will expand. If it's a downward sloping yield curve, then it indicates that the economy may slide into recession and interest rates may fall. If it's a flat one, that indicates that short-term interest rates will not change a lot. That's term structure of interest rates. Other than understanding the bond pricing mechanism, we also need to understand the most important relationship between the interest rate and bond price. And there's an inverse relationship between those two items. Higher interest rates depress bond price. Lower interest rates is good news for bond price. Right? There's an inverse relationship because interest rate is the discount rate. And technically, we can use both duration and convexity to measure interest rate risk for individual bonds. Other than interest rate risk, many bonds actually are exposed to so-called default risk. That's not typical for treasury securities, but very common for corporate bonds and other type of bonds. And bond credit rating will be very useful for investors to evaluate default risk in a typical corporate bond. So that's bond pricing and risk. And the last two topics are futures and options. And in the very basic investment class, we just talked about the nature of both financial derivative. Futures contracts actually is agreement between buyers and sellers regarding buying or selling certain assets in the future at a given price. And here, this one will tell you how to estimate, how to calculate gain and losses on the margin account when investing involved in futures trading. what's the underlying assets, what's the future price, what's the difference between long and short position, and how to use the futures for the hedging purposes and for speculation purposes. And I want you to review this chapter by yourself. And if you want to learn more detailed stuff about futures and derivatives, you have another class to take. It's confidential derivatives in this finance master finance program, which is regularly taught by Dr. Michelo. So that's a futures contract. And the last one is option. Option. Here you needed to know the difference between option and futures because they look very similar to each other, right? And both about investment buy or sell certain financial asset in the future at a given price. However, the difference here is futures contract actually is a commitment for both buyers and sellers. But for option, it's just the choice for buying. Just the choice for buying. That's why it's called option. Investors have an option to buy or sell certain number of stocks at a given price. American option actually allow investors to exercise option anytime before its expiration date. European option only allow that to happen only on the expiration date. That's the difference between American and European option. And this American European option difference can lead to huge problem for pricing in option because European option can be fixed by using Black-Scholes formula, but American option cannot be. The price of American option cannot be calculated by using Black-Scholes formula. We have to find alternative methods such as binomial tree or one-column simulation to find American option price. That's what we'll discuss in a later class. Also, you can learn more detail about option pricing. The two basic type of option, call option and put option. Call option give investor the right choice, to buy stock at a given price. That given price is called strike price or exercise price. And on the other hand, the put option give investor the right or choice or option to sell a stock at a strike price. And for either call or put option, it depends on the stock price. Sometimes option can be in the money, which means if the investor exercise the option, they can make profit. It's called in the money option. And if it's break even, it's called at the money. And if they are losing money, it's called out of the money option. For out of the money option, investors do not exercise. Why would they exercise? Simply let it go because it's choice. It's their choice. It's their right. If it's in their favor, they can exercise in the money option. But if it's out of money option, they simply let it go. They do not exercise. Let it go. And for option, I think best way to understand the gain and losses in option is to have a visualized picture on the payoff of four basic positions. And you say, hey, there's only two positions, right? Buy and sell. Actually, for options, there are four different positions. Buy a call, sell a call. Buy a put and sell a put. Those are four very basic positions, and four basic positions carries four different payoffs. Right, so make sure you understand the payoff of those four very basic positions that you to a point where you can visualize payoffs. Right? Option, put option, from buyer's perspective, and from seller's perspective. An option price, often called option premium, has two components. One is the intrinsic value. The other one is time value. Intrinsic value is value that investor can realize when they exercise the option. And if a call option is in the money, then intrinsic value equals stop price minus strike price. For put option, it's the opposite, right? And what if stop price is lower than strike price? For call option, in that case, intrinsic value is not a negative number because investor and let it go. You don't exercise out of the money option. Right? And in that case, intrinsic value can decline to 0. It can never go negative. And another part of option price is time value, because as long as options not expired, the stock price will change to a position that is favorable to investors. Therefore, any option carries not only intrinsic value but also the time value. And for option, I think it's better for you to know a little about option strategies, how to use options for speculation purposes, and for hedging, for risk management purposes as well, such as buy a call option. Right? You can speculate on stock price by buying a call option, and other investors may buy a call option not betting on stock price to increase. Instead, they are buying a call option as an insurance for their short selling position. And many mutual fund managers actually buy a lot of put options, not betting on stock price to decline, but as an insurance for their portfolio. So here, make sure you understand there are two different purposes for using options, either for risk management purposes or for speculation purposes. So that concludes basics of investments. If you're not business major for your undergrad studies, I think during the first 2 weeks, I highly recommend you to go through some basic undergrad textbook for investment. Make sure you have the basics of investment ready, so we can go advanced. So we can go advanced level study for investment. And in this class, we look at the most important part of investment, which is asset pricing. And this asset pricing is about equity products or stocks. And typically we do cash flow based evaluation, right? And other than cash flow based evaluation, also we'll introduce option pricing approach for evaluating a stock. Obviously, option evaluation for option. Here we can use option pricing model to evaluate equity. So that's advanced stuff that we will cover in this class. But before we do that, make sure you understand the basics of investment. I hope this video would be helpful for you to go through the very basic stuff for investments. And even if you majored in business or finance in your undergraduate study, I think this video will be helpful for you to have a very brief review regarding when you learn investments. I hope you enjoyed this video. My name is Kevin Zhao, your finance professor at MTSU, and I will see you in the next lecture. Thank you.